Welcome to Trends with Benefits, a podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. My special guest today is Steven Schoenfeld, CEO of MV Index Solutions. Steven joined MVIS as CEO following its acquisition of Blue Star Indices in August of 2020. Steven was the founder and chief investment officer of Blue Star, which maintained a family of indexes for global technology stocks, emerging markets, and Israeli equities and bonds. He is a 36-year veteran of the investment management industry, having served in senior fiduciary positions at Northern Trust, where he oversaw more than $300 billion in quantitatively managed global equity and fixed income portfolios, and at Barclays Global Investors, now BlackRock, where he managed more than $70 billion in developed and emerging market stock index and ETFs. Previously, he led the team at the IFC World Bank, which developed the first investable emerging market indexes and traded Japanese stock index futures on the floor of the Singapore Exchange. Having known Steven for some time now, I know him to be keen on the study of markets and in international relations, and which is one of the reasons why I've asked him on today to talk about some new developments in the global sphere. So Steven, thank you and welcome.
Thanks a lot, Ed. Great to be with you.
You're kind of a renaissance man in the investment world.
That's a very kind statement, and I will repeat that to my wife tonight.
How did you end up in Singapore trading Japanese index futures?
So while I was at my first job after college, which was at a CTA, a predecessor to hedge funds, I applied for a Fulbright scholarship to study the development of Asian futures markets when they were just really beginning. And I had this crazy premise for my thesis that the development of mutual offset between Asian markets and US markets, which was pioneered by the CME in Chicago and CIMEX, which is the predecessor to SGX in Singapore, would be the advent of 24-hour trading, which we now all take for granted. We could actually do on our smartphone, but was considered quite a radical concept then. If you wanted to trade overnight, you'd call brokers who'd call another broker and so on. So I was based at the University of Singapore. I took courses in economics, finance, a little bit on regional politics. I made lots of Singaporean friends. And when my studies were up and the scholarship was up, rather than coming back to the US, I decided to actually join the then nascent Singapore Exchange. Believe it or not, they let foreigners get a work permit if you bought a membership, and you could actually buy a membership on installment, like a car payment, and came back to the US, borrowed money from a business friend of my dad and my mom, very expensive risk capital, borrowing from your mom, did 2 weeks of floor training in the very aggressive pits of Chicago at the CME. At the time, CIMEX recognized the certification of the CME because they had a partnership. So I figured, well, if I can handle the former linebackers in the pits in Chicago, I could handle the pits in Singapore. August 1st, 1986, I started trading Japanese yen. The next month, they launched the Nikkei, and I was there on day one. And I could tell you, it may be scary amongst the locals in Chicago, but being lonely in a pit in Asia without enough liquidity is a lot scarier. It was quite an interesting experience being present at the creation of a new market. And there were no stock index futures in Japan. Singapore was the first location. The bids and offers, you could drive a small Toyota through, and somehow I survived.
How long did you do that?
So I said I'd try for 6 months if I didn't blow up, which is the usual half-life of a trader. In the end, I stayed on for 3 years, including surviving the crash of '87, which took place on the next morning, and surviving the inflation of the Japanese bubble, which was very prominent in '88. And I left in phases. I left in the spring of '89. I started grad school in the summer of '90, but I kept my membership active. I actually traded a little at night. I went back once and tried to trade for my winter vacation that was not particularly profitable. And when the Japanese bubble finally peaked, I was actually able to finance grad school by just being short literally one or two contracts of the Nikkei as the bubble deflated.
So grad school, and then after grad school, is that when you went to the World Bank?
Yeah, so I did grad school in international economics, but the right first job for me was at what's called the IFC, the International Finance Corporation. It's the private sector arm of the World Bank. And there was a small unit at IFC called the Capital Markets Department. Prior to my joining, they had created something called the Emerging Market Database. The predecessor to my boss actually coined the term emerging markets. And a few years later, together with my boss, we coined the term frontier markets, which we'll, I'm sure, talk about. But even though we had a database and some rudimentary indexes, they were not investable. The companies were not screened for actually what could be invested. There are a lot of investment restrictions that disqualified certain countries completely, certain types of companies. So we took that raw material, we went out to the market and talked to index fund shops. At the time, it was Wells Fargo, Nikko, and State Street. We talked to index providers like Dow Jones and S&P, and we applied what was then best practice to make an investable family of emerging market indexes and an aggregate, which was called IFCI, IFC Investable Emerging Market Index. And from that, we sought to create the first global emerging market index fund. People will be shocked at these numbers, but we worked almost a year and we partnered with State Street. IFC put in 10 million. And despite a roadshow in Europe and the United States, we were only able to get another 32 million. So that fund launched with 42 million. That became State Street's initial institutional emerging market capability. IFC partnered with a few other entities to launch other index funds. And in late 96, I joined what was then Barclays Global Investors. Believe it or not, they were behind State Street in emerging market indexing. And they hired me in part to help them catch up with State Street. And so I went on to build out their institutional indexing for emerging markets. And the first mutual fund or 40 Act ETFs were being managed there. They were the webs that became the initial international country iShares. So my team and I, we managed those initial ETFs. I remember pitching what was a crazy idea. Let's do a multi-country emerging market ETF. It was considered too hard operationally, and who's going to buy that, and so on. But we persisted, and as some of my former colleagues on the iShares side called it, that was their most successful mistake, because of course EEM was launched in April of 2003. It was just as I was leaving BGI, and we know that that was the first and is still one of the most successful emerging market ETFs.
Yeah, amazing. Definitely very long history in indexing and ETFs, and you've been at a number of other shops and other ventures. You mentioned a lot of different things that I think we can touch on. One being Israel, one being just emerging markets in general. You and I have gone back and forth on the terminology there before. Thematic investing. There's a lot of stuff that we can cover with you. But let's talk a little bit more about Israel, because recent developments in the geopolitical sphere have transpired, where now the UAE and Bahrain are the third and fourth Arab countries to recognize or open diplomatic relations with Israel. I wanted to get your take on this and your thoughts about how significant those developments are.
So clearly, we at Blue Star were focusing on Israel for over a decade, and a lot of our early research looked back 10 or 20 years earlier. So we've looked at the history of Israel's economic development for 20, 30 years. The potential for normalization and peace with Israel's neighbors was always out there, and we believed in it. We hoped for it. We even designed some prototype indexes that would accommodate it. But the speed at which this normalization has happened, you mentioned Israel's first peace treaty, Egypt 1979, Jordan 1994, and then in the last few months, UAE in August, Bahrain in September, and things are moving so fast, Ed, that we had another one this month, October, with Sudan. What's fascinating is that almost no one in the region, whether Arab, Israeli, or European or American diplomats, believe that that's the end. The only question is, will the next country be Oman? But even outside of the region, people forget that there are Muslim countries outside of the Middle East that have had also under the surface relationships with Israel, but have waited for peace to normalize. And the biggest also happens to be the biggest Muslim country in the world, and that's Indonesia. And Israel has had quiet relationships with Indonesia, unlike its relationship with Malaysia, which has been more contentious for many, many years. And I think, one of the big surprises we could see in 2021 is Israel establishing full relationship with Indonesia, which is a huge country, huge economy, hugely strategic in Asia, where Israel already has very strong relationships with Singapore, with Taiwan, with China, with Japan, Hong Kong, Korea. I mean, I could keep going. So a lot of positive knock-on effects within the region itself. It's hard to find the right superlative for how earth-shaking this shift is. So Israel still has historic foes, most notably Iran and their proxies like Hezbollah in Lebanon, Hamas in Gaza. But the Arab Gulf is the center of dynamism and wealth in the Arab world. And the warmth and speed at which relationships have been normalized, it's mind-blowing. I've done a little writing on it, and I had to keep changing the tense. I'd say, I would expect that within a few months, there will be direct flights between Israel and UAE. And that's already happened. And Saudi Arabia is allowing overflights. And so you've already seen actual deals be announced, joint ventures, partnerships between Israeli hospitals and UAE hospitals, and even the Abu Dhabi Investment Office, which had never had a foreign office before, a few weeks ago announced that they're going to start opening offices around the world, but the first one is going to be in Tel Aviv. So this is really substantial and is a lot more than symbolism. There's going to be a lot of tangible benefit. I mean, just in the investment area, let me give you one example. When I was at BGI, now BlackRock, and also subsequently at Northern Trust, we had relationships with the big sovereign wealth funds in the Gulf. They're amongst the largest investors in the world. I managed their global equity portfolio. Usually it was benchmarked to FTSE or MSCI, but they had a custom index. The custom index for most of the sovereign wealth funds in the Gulf was, for example, MSCI World X Israel or FTSE World X Israel. They specifically excluded Israel because that was their policies. That was the Arab world's policies. Well, just including Israel in those portfolios itself will mobilize a lot of capital into Israeli equities. It's not going to all happen in 1 minute. It will be deployed passively, actively, private equity, public equity, but it's going to happen. You're also seeing the capital market authorities, the regulators in UAE and Israel start to ink memorandums of understanding, and the Tel Aviv Stock Exchange already indicated that they're going to be seeking something similar with the Dubai Exchange. So quite substantial. I think it will benefit Israeli equities unambiguously, but more importantly, I think we'll see some interesting reconfiguration of how Gulf investors and Israeli investors invest in the region, because much of their investment has been focused to the rest of the world, toward Europe, the US, and Asia. Of course, they invest in their domestic market, but the Israelis were not big investors in the Gulf markets, and the Gulf investors were not big investors in Israel. And you're going to see acquisitions. Dubai Ports is going to be a bidder on one part of the Haifa shipyard and port that's going to be privatized. So I think there's going to be
investments both ways.
Investment both ways. The last thing I would mention is, I guess I'd call it geoeconomic. The geoeconomics, everybody's aware of the risk of oil leaving the Gulf, going through the narrow Straits of Hormuz, often threatened by Iran, and the risk to ships. We've seen it for 30 years. There will now be a pipeline from Dubai through Saudi Arabia to the Red Sea, and from there, it can go to the Mediterranean. It will save days and a lot of risk in moving energy. You also might see Gulf investment in the natural gas fields that are just offshore of Israel. So you'll see a lot of changing on the geoeconomic map. And the United States is very involved in that. This new pipeline, the US government's going to be involved in financing that.
So the investment markets in Israel were already fairly resilient. And as you mentioned, Israel had actually graduated from emerging to developed in 2010. What's your just general take on the state of the EM index and frontier index kind of terminology and coverage?
So there's several interlocking issues in your question. The first is the issue of graduation, country classification, how the borders of emerging are defined, both the border between emerging and developed and frontier and emerging, and whether there needs to be, let's call it, some review of that. And I certainly think there should be. Two, there's the issue of what is an emerging market index. Investors are very comfortable with the idea of international developed market indexes or global market indexes, although American investors are benefited from the fact that the US is generally not in our international indexes. When you're sitting in the Netherlands or Hong Kong and you look at international indexes, the US dominates. The US looks like China does in emerging to a global investor. And so the issue of single country concentration was always something that needed to be dealt with. There was a huge issue with Japan's weight in IFA, the developed markets, back in the late 80s, in the aforementioned bubble that we talked about. What has happened now in emerging markets is unprecedented. You've never had a single country so dominate the index. When we first built the IFC Emerging Market Index, and then at BGI BlackRock, when we first managed money against it and the MSCI index, occasionally you'd have one country at 25%, but it usually wouldn't last long. It would have some correction. Ironically, those countries were Mexico, Taiwan, Malaysia was once at that weight. Those are very small countries now, not Taiwan. But to have a country like China at 45% of the index, and I checked before we had this conversation, it is literally at 44 to 45% in the MSCI, the FTSE, and the S&P Emerging Market Index. The S&P Emerging Market Index is actually heavily derived from what was the IFC index from 30 years ago. So it still has its roots there. The concentration is worst in FTSE because FTSE considers Korea developed. It's a little less extreme in MSCI because Korea is still an emerging market in MSCI. So as I said, there's a number of issues here. Let's discuss first, before we discuss the China issue, let's discuss what is an emerging market. The roots of the term emerging markets, as identified, came out of the World Bank. And we use the World Bank's definition of a developing economy. In fact, before the term emerging markets was coined, and my predecessors at the capital market department were developing the first fund for investing in the stock markets, the initial name for that fund was going to be the Third World Investment Trust. There was two problems with that. Third World was considered derogatory. And two, the acronym was going to be TWIT, which is not a great ticker symbol or acronym. And so the term was coined emerging markets, but the definition was always rooted in the World Bank, IMF view of the world of what is a developing country and what is a developed country.
What is that? GDP per capita? Is it
heavily? Yeah. It's
okay.
GDP per capita, underdeveloped governance, but the initial gating was GDP per capita. So, somewhere in the library behind me, I've got the original book we put together in 1993 to define it. And at the time, Taiwan and Korea were still emerging markets by that standard, although they were already pushing. The problem was that Korea has continued to develop, but so has Taiwan. But Taiwan still has a few investment restrictions. So one of the other important things was you could be emerging in the category, but you couldn't graduate to develop until you met a more developed market operational, DVP, trading, a lot of the infrastructure of investing.
The ability for international investors to interact more efficiently and openly. Yeah.
Thank you. Yeah. Free delivery of shares, sec lending, things that are in the ecosystem for trading. So you had this anomaly that Korea and Taiwan, which are both unambiguously developed markets as far as stage of their economy, GDP per capita. They're both democracies now. That isn't necessarily a criteria, but some people consider it. They're both members of, well, Taiwan isn't for political reasons, but Korea is a member of OECD. And yet, because Korea still has some restrictions on foreign investors, MSCI hasn't graduated it, although FTSE and S&P has. It creates an anomaly. And before we get to the China issue, my view is that we need to reassess how we define emerging markets and get back to the initial roots of it having some correlation with stage of development. Emerging is exciting because it implies growth, change, positive change, but it also implies you're coming from a lower point. So I think we have to get more true to that. And it's not just about the anomaly of South Korea and Taiwan. A number of the Arab Gulf countries, which with great fanfare moved from frontier to emerging, which have been good for their capital markets. You got to put them somewhere. They're not developed yet, one could say. Certainly Saudi Arabia still has investment restrictions. But think of the absurdity, and I don't want to pick on Qatar, okay? But Qatar has a higher per capita GDP than the United States or the UK or France, and yet it's in emerging. It's absurd.
Is that due to their infrastructure, their
exactly?
Yeah,
due to the infrastructure. Kuwait is about to go in, right? Kuwait has per capita GDP of 34,000. That's more than a number of European countries. UAE, 43,000. So Israel, which did graduate to developed, has a GDP per capita of 42,000. UAE, and you can see why there's synergies between the UAE and Israel, 43,000. Does it really belong in the emerging markets?
But surely some of those investment restrictions or those keeping in mind those different investment restrictions for investment purposes have got to be a good thing or got to serve a purpose.
Yeah. So I'm not saying I have the right solution for where they should go, but we need to question why they might be in emerging. Of course, you go from frontier to emerging to develop, but maybe we've reached a point where investors should look at the economics more. Look, Ed, you know this. ETFs and futures and other things can help get through investment restrictions, right? So there are the possibilities of access products. Vietnam is still a frontier market. They would be smack in the middle of emerging markets if they didn't have the foreign investment restrictions. So I don't have the solution, but I think we need to break the paradigm a little bit and reassess it. And the catalyst for that, back to one part of your initial question, is China. So talk about elephant in the room. This is the panda in the index, okay? But it's a giant panda. It's a 45% of the weight. And just take away indexing for a second. FTSE and MSCI are the dominant benchmarks today for emerging market active managers, not just emerging market index managers. The average active manager, they wake up in the morning excited, and they go to sleep dreaming of finding the right stock in Thailand or Indonesia that's going to help them, beat their benchmark. Well, you could be the best stock picker in emerging markets. It's going to mean nothing if you don't get your China weight right, because China is 45% of your index, right? And so the China decision, just like the Japan decision in IFA in '89, is so dominating any other decisions that benchmark it's kind of crushing active management, in my opinion, too. And of course, it's distorting the several $100 billion in ETFs that track the main indexes, right? The top 5 ETFs, broad emerging market ETFs, track one of those 2 indexes. Well, add in S&P, right? One of those 3. They're all 45% China. The other thing is, and we've seen, everyone talks about the weight of FANG in US indexes and how it dominates. It's worse in emerging markets. It's just 2 stocks, Alibaba and Tencent. Alibaba, as of today, is 8 to 9% of the index. That means one stock is bigger than all but the top 3 countries in the index. Alibaba is bigger than Brazil. It's bigger than Russia. So it's so skewed, it's so distorted that something's got to give. At Blue Star, we started a lot of research on this. It's now taking place within MVIS. There's a whole range of solutions. The market will dictate it, but we also need to do research. But it would be my view that we are very much overdue to reassess how we organize our emerging market allocations, whether it's active managers or index managers.
Yeah, totally. And I think it's going to take institutional support there too, right? To help really bring across some change.
Yes. And so one of the things we hope to do, and I'll let this news be broken on your podcast, as an index provider, we're going to start doing outreach to institutional investors and their consultants, both highlighting these issues and proposing a range of solutions that we've developed. So if you think about the weight of China and the concentration at the country level, the sector level, and the stock level, one way to address this is to come up with alternatively weighted indexes that attenuate country, sector, and stock weightings, but to do so in a thoughtful way that actually looks at stage of development, operational risk, all these other drivers in emerging markets that have been in the consideration, but the sequencing might have gotten jumbled over the course of the last 20 years.
And you would need an institution to adopt that as a performance benchmark, even so that they can minimize their tracking error. And
yeah, so it could be, this is the classic, Ed, this is the classic chicken and the egg. And you and I were partners in 2013, 2014, when we were trying to persuade certain endowments and institutions to look at Israel another way, right? So I think it will be a conversation with institutions and their consultants, and a conversation with issuers, like who wants to be the first or second to break this paradigm. So, but at the foundation, and what the first 6 months is going to be, education, dialogue. Something new and better will emerge, probably several new and better ideas. And I look forward to just being part of the discussion. Also, we're very lucky. We have an index advisory committee that we're going to be utilizing as a sounding board for this as well. And there's a lot of knowledge and experience in emerging markets in that grouping as well.
So what's one long-term trend you see playing out over the next year or several years?
Only one.
Your favorite?
I think a trend that has started, but most people wouldn't yet define as long-term, is thematic investing. I think what is going to be a powerful change in the next few years is the conversion of people's perception of thematic being tactical, opportunistic, into something more strategic. What has to be solved is, how does that fit in with sector investing and other traditional size and style allocations? Will the marketplace develop a kind of bucket, a dedicated allocation for thematic tech or disruptive tech, whatever the phrase that wins the day? Will index providers such as ourselves or others build a full suite of thematic that is inclusive and can be compared directly with a sector view of the world or a country view of the world? Like, will it be a third view of the world? I'm not sure which path, but I think the industry will find a solution. And I think that we will find people building portfolios of themes and rotating amongst them within the same way people do with sectors now. I think it's a very powerful trend. And it's not just in the United States. We see it strongly happening in Europe. Israel's a major market for us, and we see investors adopting it there. It's not yet fully accelerating in Asia, but I think it will as well.
Let's do trend or fad. I'm going to mention a few concepts. You let me know just kind of quickly, trend or fad. Cryptocurrency, trend or fad?
I used to think it was a fad, but it's definitely a trend. I was on a call earlier today, and to kind of a crypto veteran, and I said, some of the arguments that we're beginning to see developed, making the investment case for digital assets, totally reminds me of the case I was making 25 and 30 years ago for an allocation to emerging markets, when that was considered a crazy, wild investment, right? And so you're beginning to see the use of data, the use of past returns, risk and return starting to be applied, a portfolio approach to a basket of cryptocurrencies. So it is part of what's convinced me.
So we've got a convert.
Well, when you're sitting outside and you see, day traders on Robinhood and eToro, and chat boards talking about crypto, it's very easy to dismiss it as a fad. But when you see sophisticated investors, large pools of assets starting to be deployed, it's the kind of thing that will change one's mind.
How about fractional shares, trend or fad?
It's no longer a fad because you've gotten very large players to adopt it. And to the extent that investors onboard it, it's going to stay. And in fact, to the extent that you have large, high-priced stocks that are not splitting, it's a better deal for investors. And if you've got zero commission on one or the other, it's good. I would recommend to my, cousin who's in his first job out of college, better to be diversified than to just hold one of the fangs. So reluctant trend.
And then finally, active non-transparent ETFs, trend or fad?
Active ETFs are a trend. Whether it's active non-transparent is a fad or not, jury is out. A ETF trend, Ant ETF, not sure yet.
Fair enough.
Yeah.
Steven, this has been awesome. How can people find you and follow you?
So on Twitter, I am at SA Schoenfeld. Our website is mvis-indices.com, and that'll lead anyone to me.
Thanks again, and thank you for tuning in to another episode of Trends with Benefits.